To handle this problem, you have to recognize a couple of things. I think the questions I've seen from most of you show me that you've got taxable income correct. So, that's just sales minus deductions, and then recognizing that tax depreciation is another deduction. It's not a cash expense, so it's listed separately down here. But most of you got taxable income to be $95,000, and then most of you figured out the corporate tax liability down here using the rate schedule in the front of the textbook. Where the problem came in is in this box right here, available cash available for dividends before taxes. So the key is cash available. So what you don't want to include here is non-cash items, but you do want to include all cash items. So sales, even if it's not cash, immediately when the sale occurs, will turn into cash as soon as the sales are collected. So you take all 150, you add this interest income because even though it's tax free, it still represents cash coming in again eventually. So that's 155. These are cash expenses, so you deduct that; those would be paid. So you're down to 125. Tax depreciation is not a cash deduction or cash expense, so you leave the cash before dividends at 125. Then you subtract the corporate tax liability that you calculated up here to arrive at the cash available for dividends after taxes. This is the cash that would potentially be paid out to shareholders and which would be subject to this 15% tax rate. And once that is subtracted from the cash available for dividends, you would arrive at after-tax cash flow. Now, since that cash flow would be received a year from now, you have to figure out what today's value of that cash is by present valuing that number back to um, um, the current time period. Let me look. I guess this is. I guess we're talking about 2011. So 2012 is a year from now. I don't know how that's exactly obvious here, but it says compute the present value of cash flows for 12 through 14. Expects the business to grow over the next 3 years. So there's the statement that the current year is 2011 because these are the next 3 years. So we're bringing back whatever that number is 1 year, and you use these present value factors right here. So you multiply that factor by whatever number you get right here, and that gives you the present value of cash flow. You should be able to follow that logic through the other years and down here to this part B. So please email me if you have any other questions.